Good afternoon. Thank you for joining us. We are Cal State Fullerton pitching a sell recommendation on Avery Dennison. We want to thank the CFA Institute and Avery Dennison. I'm Ali.
I'm Philip.
I'm Mohammed.
I'm two.
And I'm Alex.
Avery is everywhere, whether it's the label on your water bottle or the tag on the inside of your shirt. But if Avery is everywhere, well, just how big is Avery? Well, in 2019, they generated over $7 billion in revenue. They operate in over 50 countries and employ over 30,000 people. 23% of their revenue comes from the United States, 31% from Europe, 35% from Asia, with the rest scattered across the globe. Avery's largest segment is their label and graphics materials segment, also known as LGM for short, which accounts for 67% of total sales and includes products such as labels and adhesives used by food, beverage, and sign manufacturers, to name a few. However, Avery operates in a highly competitive and fragmented industry, and we can see that when looking at their market share, which is shaded in red, where they do lack market share capture relative to their peers, with the exception of their pressure-sensitive materials market. Their next segment is the Retail Branding and Information Solutions segment, also known as RBIS for short, which accounts for 23% of total sales and includes products such as embellishments and RFID tags used by grocery stores and retailers, to name a few. Once again, Avery operates in a highly competitive and fragmented industry where they do lack market share capture relative to their peers, with the exception of their product labeling printers market. And lastly, their Industrial and Healthcare Materials segment, also known as IHM, accounts for only 10% of total sales and includes products such as drape tapes and adhesives used by medical device manufacturers and construction firms, to name a few. And here, we can see how Avery severely lacks market share capture relative to their peers, capturing a very little to no market share. With that, we'd like to reiterate our sell recommendation with a target price of $79.13, representing an overvaluation of 18.19% due to a slowing LGM segment, a growing but vulnerable RBIS segment, and an IHM segment that's not delivering, leaving Avery stuck in a sticky situation. So, Philip, can you tell us what the outlook is like on these businesses?
Sure. Avery's businesses, especially LGM, are tied to global consumption. Recent events such as the coronavirus have caused economic estimates to be revised down, a sign that global consumption will suffer moving forward. Also, based on a recent conference call with Avery's CEO and past recession performance, our outlook for Avery's entire business is actually quite dim. We did factor our projections for this outlook into our evaluation. Looking at the individual segments, we see that the LGM segment is slowing because it's in a declining industry. Foreign producers have put price pressures on domestic companies, forcing them to either offshore their operations or cut back their profitability. As a result of this industry decline, the segment's margins, as shown in the red line at the top of the graph, have stagnated and organic growth has been volatile. Overall, the LGM segment is negatively affected by our slowing global economy, events such as the coronavirus, and operates in a declining industry. Therefore, our financial projections for the segment show a downtrend. Meanwhile, the RBIS segment has actually done quite well in previous years, but slowing global consumption makes its retail business vulnerable. RFID has also been a big driver of company growth, but may follow a similar short-term downtrend as retail. RFID stands for radio frequency identification. It's where people use radio waves to identify or track a tag attached to an object. There are two types of RFID, active and passive. The main difference is that active RFID constantly emits a signal. Overall, the RFID market is expected to grow at a 3.9% compound annual growth rate moving forward. Our team credits management for investing in the RFID space, but found it limiting that such a big portion of company growth only accounts for about 8% of total revenue. Also, Avery only partakes in the passive RFID industry, which is heavily fragmented and competitive. This is seen with their 3% market share position, despite being a market leader. Lastly, Avery might be missing out on some opportunities in the active RFID industry, which is quickly growing in popularity. Ultimately, our long-term outlook for RBIS remains positive, but we can't help but ask ourselves, why isn't there more revenue tied to RFID? Also, an increasingly vulnerable passive RFID industry does raise some concerns. That's the RBIS segment. Mo, can you tell us why the IHM segment hasn't delivered?
Absolutely. Well, in order to understand that, we need to know how the IHM segment came into the picture. If we look back to 2015, the company underwent a restructuring process that led to the creation of IHM. Avery emerged its underperforming advanced medical technology segment with underperforming subsidiaries from the RBIS, as well as the precious-sensitive materials segment. Despite the restructuring efforts, we can see on the top line of the chart, the margins are still declining. Avery is a second-tier player with 0.5% market share in a highly fragmented industry, giving them negative pricing power. Thus, we do forecast margins to continue declining. Also, the segment is heavily reliant on acquisitions for growth. As we can see on the bottom line of the chart, they had very little organic growth. We do expect organic growth to be lower than it's been historically due to the reliance on acquisitions, and for that, we believe the IHM segment represents a misallocation of capital. Even outside of IHM, the company's strategy actively seeks to acquire other companies, so it's important to see where their leverage stands. With $1.9 billion in debt and a BBB credit rating, the company's leverage ratios are near historical highs. Taking into account the reliance on acquisitions and the volatility in the market, we question the sustainability of their strategy. Therefore, we do believe they are positioned unfavorably despite the access to affordable financing. So Tu, could you please tell us how you factored all that into the valuation?
Yes, so we did that by using multiple valuation methods. We also take into account the recent development with the coronavirus in March into our DCF model. Hence, the LGM has a 5-year average organic growth rate of 2% due to declining industry, a 5.7% for RBAS to account for the highest growth in RFID technology, while IHM have a negative average growth rate for being a second tier in a fragmented industry. Overall, Avery have an average growth rate of 2.7%. Here are our other assumptions. We calculate an 8.3% cost of equity, and we use the average due to maturity on Avery 5-year bonds as the cost of debt, which gave us a 7.4% WACC, and eventually a price of roughly $81. Avery operate in many industries. That's why we also did some of the parts valuation. We use a 7.6 multiple for IHM, 8.9 multiple for RBAS, and 7.5 multiple for LGM. As such, we value Avery at 6.6 multiple and giving us a price of $77 roughly. We averaging these two prices and we arrive at $79.13. We also did a scenario analysis, which is available in the appendix. Lastly is a historical valuation. The gray bar represents Avery 10-year average valuation metrics. Not only there's a spike in 2019 valuation, but the LTM numbers are higher as well, even with the COVID-19 event. Ultimately, Avery looks expensive. So Alex, what led into the overvaluation?
Well, in order to understand how Avery has done so well, we must look at past events that have affected stock price. In 2012, Avery benefited from the divestiture of their office and consumer products segment. Then it surpassed the S&P 500 in 2015 due to declining commodity prices and organizational restructuring. Overall, the past 10 years have been one of the longest expansionary periods in the US, which has benefited Avery's businesses. Most recently, though, we can see that the coronavirus has profoundly affected Avery as the global economy faces a recession. This global contraction has peeled back all labels as RFID success can no longer overshadow the underperformance of IHM. Therefore, we are recommending to the CEO of Avery, Mr. Boutier, and upper management the divestiture of IHM, which we valued around $660 million using our sum of the parts valuation. By divesting IHM, management can invest where they have seen success, which is in RFID. This investment will increase their 3% market share in passive RFID and allow them to enter the active RFID space. Having IHM misaligns management's incentives by detracting Avery from increasing their free cash flows and adjusted earnings per share. Yet, with the current economic environment, management's window to sell IHM is slipping away, making things stickier. So once again, we would like to reiterate our sell recommendation of Avery Dennison due to a slowing LGM segment, a growing but vulnerable RBIS segment, and an IHM segment that is not delivering. Our valuations gave us an average target price of roughly $79, making Avery roughly overvalued by 18%. Thank you for your time.